the Chairman, Kenya Bankers Association, Paul Russo, members of the KBA Governing Council present, the Chief Executive Officer, Kenya Bankers Association, Raymond Molenje, CEOs of commercial banks present, ladies and gentlemen, good morning. It's a great honor for me to join you this morning for the 14th Kenya Bankers Association Annual Banking Research Conference. Let me take this early opportunity to first congratulate the KBA for organizing this conference for the 14th year in a row, and second, to thank the KBA for inviting me to come and deliver the keynote address. The focus of this conference, banking and economic growth dynamics, navigating risks and leveraging opportunities in MSMEs financing, aptly captures the policy objectives of the CBK and indeed those of the government. And I commend the KBA for its continued collaboration with the CBK on critical issues in the banking sector. Ladies and gentlemen, a necessary condition for sustained economic growth and development is a stable macroeconomic environment. The Kenyan economy remains resilient to global geopolitical as well as domestic shocks, with real GDP growth of 4.7% in 2024 and 4.9% in the first quarter of this year. The economy is projected to grow by 5.2% this year, and further 5.4% in 2026 on account of a strong performance of the services and agricultural sectors, supported by a recovery in credit to the private sector. Overall inflation is well anchored within the target range of 5 plus or minus 2.5%, having declined from 9.6% in October of 2022 to 4.5% in August of 2025. This inflation outcome reflects the impact of monetary policy measures, stability in the foreign exchange market, and improved weather conditions. We expect inflation to remain within the target range going forward, supported by stable food and energy prices, as well as the continued stability of the exchange rate. The foreign exchange market has remained stable, supported by a narrowing of the current account deficit, reforms in the interbank market, and investor confidence in the economy. The current account deficit is estimated to have narrowed to 1.6% of GDP in the 12 months to June of 2025, compared to 1.6% of GDP in the 12 months to June of last year. This reflects improved exports of goods and services, strong diaspora remittance inflows, and lower oil imports. The capital account and financial account inflows more than financed the current account deficit, resulting in an overall balance of payment surplus and a buildup in foreign exchange reserves. Last year, we started the year with a reserve of 6.5 billion, and we were able to build reserves by the end of December to about $9.3 billion. This is the highest level of reserves we had up to that point. And of course, since that time, with the improvement in the current account, we have been able to go into the market, purchase more foreign exchange, and now we are at about 11 billion. And I expect that the current account transactions will continue to record a surplus going forward, and therefore that will afford us another opportunity to keep on building our reserve position and really to strengthen our external buffers. The banking sector plays a critical role in supporting this robust growth and contributing to price stability. A stable and resilient banking sector is an engine of growth through credit intermediation. I'm happy to note that the banking sector remains profitable, stable with adequate capital and liquidity buffers, and generating public confidence. supportive regulatory environment, robust supervisory practices, stable macroeconomic conditions underpinned by improving business environment continue to contribute to this stability and resilience. There are, however, developments in the domestic and global economies that require us to be more vigilant and to take measures that mitigate against emerging risks. For instance, technological innovations in the financial sector have increased efficiency, developing products that are relevant and identifying potential customers and their needs. However, digitization of financial services has also elevated cyber risk exposure to banks and to their customers alike. This is the time to beef up cybersecurity defenses to mitigate cyber risks and thereby ring-fence the stability of the financial sector. Towards this end, the CBK has undertaken measures to ensure the banking sector remains strong and continues to finance the economy. And these measures include raising the core capital requirement of the banks from 1 billion shillings to 10 billion shillings over the next 5 years, refining the monetary policy implementation framework towards an inflation targeting regime whereby we establish a corridor around the CBR and open market operations are designed to ensure that the interbank remains very close to the policy rate. The review of the risk-based credit pricing framework to enhance transparency in credit pricing and promote new financial products, which while enhancing monetary policy transmission. The issuance of the Kenya Green Finance Taxonomy and Climate Risk Disclosure Framework for the banking sector to guide investment and mitigate climate change risks. And finally, other initiatives have included unlocking the functioning of the foreign exchange market, getting rid of the dual exchange rate, and the introduction of the electronic B-match for enhanced transparency and more efficient price discovery. These initiatives, ladies and gentlemen, put the banking sector at a strategic position to effectively meet the financing needs of the economy, including the MSMEs. As we gather today, the MSMEs contribute to employment of over 70% of Kenyans and account for over 30% of GDP. This contribution can be increased if the MSMEs have access to finance, a good business environment, including regulations that are supportive of MSMEs. Addressing financial needs of MSMEs is even more urgent due to providing employment to the youth, as well as producing essential goods and services. And in light of the ongoing reduction in the CBK policy rate, it is my expectation that banks will further reduce their lending rates so that credit to the private sector can increase along the lines that Paul just talked about, and to increase from the current growth of 3.3% as of August to over 10% by the end of the calendar year. And I really challenge you to aim for this and achieve this target. The gain in financial inclusion registered in our country has been supported by conducive legislation and regulations, as well as innovation. As of 2024, Kenya's adult population access to formal financial services was 85%, way above the 27% that was recorded in the baseline survey of 2006. While this transformation is impressive, we note a large population comprising of women, rural residents, youth, people with disabilities, and farmers face higher level of financial exclusion. There are also people who think that the financial sector is not meeting their needs, And this is mainly reflected in the low financial health score of only 18% in 2024, which is down from 39% in 2016. There are also consumer protection challenges, including lack of transparency in credit pricing, unethical debt collection practices, among others, which have come with unintended consequences. All these issues, distinguished participants, must be addressed through data-driven policies, deliberate strategic initiatives, and partnerships between the private sector and the public sector. To address the above challenges and further increase financial inclusion from the current 85% to 90%, the CBK, in collaboration with the KBA and other stakeholders, have developed a National Financial Inclusion Strategy 2025 to 2028 that we expect to launch shortly. I think one of the things that the strategy is ready, has gone through the key stakeholders, and I think the idea was to launch it maybe before the end of this calendar year. I'm looking at FSD, Tamara Cook, and she's shaking her head, saying yes, we're supposed to launch it, and that's the target. But we had a discussion about it yesterday under the Financial Stability Committee, and we thought it might be useful to have further public participation. So we do intend to, again, just circulate it to the public for further comments before we launch it. So this strategy is anchored on deepening access and usage, strengthening market conduct, consumer protection and financial literacy, developing and fostering inclusive and green finance, promoting rural agricultural finance, and improving access to finance for women, youth, MSMEs, persons with disabilities, and forcefully displaced persons. The realization of the objectives of this strategy requires concerted efforts of all stakeholders, and I strongly believe that our partnership with KBA and other key stakeholders will be decisive. Let me conclude by once again reiterating the importance of this conference to our country and the banking sector. The blend of senior and young scholars, policymakers, practitioners, and researchers signify the importance of this conference. I'm confident that the conference will enhance understanding of the issues that constrain the banking sector from contributing effectively to economic growth and lending to MSMEs. I'm also confident that deliberations will yield solutions and identify areas of collaboration to harness the full potential of the banking sector in supporting MSMEs. I know I've mentioned very briefly the new risk-based pricing model, but I think it will be remiss on my part if I didn't say just a little bit more on this new framework for setting interest rates. And I want to echo Paul's point that this framework is not about controlling interest rates. We all know the impact of controlling interest rate. We have tried it before. It didn't work, and we are not going back to that regime. Now, the key mandate of the central bank is one, to ensure that there's stability in the general level of prices, which of course is inflation, and we have interpreted that mandate to mean that we target an inflation rate of 5% plus or minus 2.5%. The second mandate of the central bank is to ensure financial stability. And we believe that we have broadly achieved the two objectives. I think inflation now is, as I said earlier, is 4.5% in August. And I think some of the actions that we have taken in terms of even raising the capital requirement of the banks further strengthens the financial stability of the financial sector. So the third mandate of the central bank is subject to achieving price stability and financial stability, is to help the government in achieving its growth objectives. And I think that's where we are. I think we took some very strong monetary policy measures in the last 2 years, and it bore fruit. We were able to stabilize prices, we were able to stabilize the exchange rate, and I think it's now time to pivot from stabilizing to now encouraging production. And that's why we have reduced the policy rate, I think seven times in a row, by 350 basis points. And when we were raising the policy rate, I think all of you will agree with me that the banks were very quick to respond to an increase in the policy rate by raising their lending rates, which was the intention. The intention is to reduce aggregate demand and bring aggregate demand towards production, and therefore reduce excess demand, and that's how you address inflationary pressures. But when we now started to lower the policy rate, we could see there was some reluctance on the part of the banks to lower their rates. And as I said, we have lowered the policy rate by 350 basis points since August of last year. The Treasury bill rates have declined by 50%. Yeah, Treasury rates were about 16, 17%. They are now, even the 91-day Treasury bill is now below 8%. Yeah? But the average lending rate of the commercial banks has only reduced by 200 basis points, from 17.2 to 15.2 on average as of August. And so therefore, there was this asymmetry. When policy rate goes up, banks raise their rates. When policy rate goes down, banks are reluctant to lower their rates. Now, I know the previous risk-based pricing model may not, I know they had some shortcomings, and one of the shortcomings was the fact that there wasn't a common reference rate. There wasn't a common base rate. Each bank had their own base rate. And so it introduced some vagueness. There wasn't much transparency as to how the banks would be setting their rates. And so that's why this new framework, which is KESONIA. KESONIA just stands for the Kenya Shilling Interbank, Overnight Interbank Average, plus a K. This KESONIA will be the common reference rate for all variable rate loans, except for the foreign currency denominated loans. All other loans will have the base as the KESONIA. And all banks will also have the same reference rate, which means under our current monetary policy, as I said earlier in my formal statement, we do have a new monetary policy framework. We set the policy rate. We have a margin now on either side of 75 basis points, but every time when we change the policy rate down, we go into the market, inject liquidity, and make sure that the interbank rate also goes down to where the policy rate has been reduced. And since the interbank rate is actually the KESONIA, what will happen in future is that every time the policy rate goes down, KESONIA goes down, and all variable rate lending rates also go down immediately. So there won't be an excuse by the banks that for whatever reason, there's quite a number of excuses. So this time there won't be an excuse. Once we lower the rate, then the banks should also lower their rates. And I really do believe that Kenyans prefer this kind of a transparent way of setting interest rates. And if I were a CEO of a bank, I would move as quickly as possible to implement this framework. I know we have given you 3 months for new loans and 6 months for existing loans. But if I were you, I would move as quickly as possible to implement this framework, because Kenyans want a transparent framework. And Kenyans will choose to go to the banks that have a transparent framework. So the longer you wait, you might find that your customers will be moving away from your bank to a bank that is having a transparent way and to be able to explain to Kenyans how their interest rates are being determined. So I urge you to call for board meetings, get your framework approved, and then you send it. You start implementing. You don't have to get any permission from the central bank. You just need to inform us after the 15 days of the board approval that this is how you're going to be setting your interest rates. So, with those few remarks, it's now my honor to declare the conference officially opened and wish you productive and insightful deliberations. Thank you very much.